Welcome back to Alpha Recap. I'm glad you joined us. We're looking back at a pretty decisive risk-off day in the market, and we'll unpack what drove it, what held up, and what to watch next. As always, if you have questions, you can reach us at stockalpha.ai.
Great to be here. Lots to chew on from today. So much that moved in a single session. Let's jump in.
All right, first things first. The headline numbers. The S&P 500 closed down about 1.3%. The Nasdaq 100 finished down about 1.5%, and small caps, the Russell, were hit hardest, down about 2.3%. Big picture, that pattern. The Nasdaq underperforming the S&P and small caps trailing worst screamed risk off. What was your read on that, Matt?
When you step back and look at this, it was a classic de-risking move. Investors shifted into safer assets late in the session. Defensive sectors and commodities picked up flows, while cyclical and levered names got punished.
So, what really stands out here is the mix of drivers. There wasn't one single headline. It was oil, banking noise, policy chatter in real estate and cannabis, and renewed pressure in crypto-linked names. All of it added up.
Right. And the other thing is how quickly an oil move can change the psychology. Even a short-lived spike in crude injects inflation worries into the tape.
Yeah, that was obvious in the sector action. Energy was one of the few pockets of strength today, right?
Exactly. Energy outperformed as crude rallied, and integrated producers, exploration and production names, and transport/storage players benefited. When oil pops, it does two things. It helps energy stocks, and it makes the inflation story louder for everyone else.
Utilities and staples held up better too, the usual safe haven suspects. Investors chased yield and stability.
Yeah, absolutely.
Meanwhile, materials saw selective strength. Miners and commodity plays rallied on supply narratives. But real estate was a clear weak link. Policy headwinds and higher rate sensitivity hit that group hard.
Honestly, I was a bit surprised by how pronounced the real estate weakness was. A few deal-specific policy issues and the fear of higher financing costs made investors run for cover in that sector.
Banks were mixed. Large, diversified banks were sturdier, but regional lenders and names sensitive to credit conditions lagged, which fed into the small cap pain. Let's pause and explain something for listeners who aren't traders. Why does a small cap rout often signal broader risk aversion?
Sure. Small cap stocks tend to be more cyclical and more dependent on easy credit and healthy economic growth. When investors get jittery about banks, financing, or growth, they trim those names first. So when small caps fall harder than large caps, it's a sign people are moving away from riskier, growth-sensitive positions.
Nice and clear. Now, specific drivers. Oil first. How did that play out today?
Crude spiked on tighter supply chatter and geopolitical noise. That pushed energy higher and raised the odds that headline inflation could tick up. The market reacted by repricing shorter-term inflation risk, which feeds directly into expectations about central bank behavior down the road.
Okay, on to banks and credit. Mixed signals kept the tape cautious. Can you walk listeners through why that matters for the overall market?
If lenders pull back, credit becomes harder to get, which slows investments and consumer activity. So even if inflation is controlled, a credit squeeze can tip growth lower. That trade-off, inflation versus financial stability, is exactly the headache the Fed would rather avoid.
And policy headwinds in sectors like real estate and cannabis added to the uncertainty. There was even chatter about Schedule 3 for cannabis that briefly lifted names, then faded.
Yeah, rumor-driven rallies tend to be fragile. The cannabis bump was short-lived once the market remembered the broader risk-off tone.
Crypto-linked names took another hit too. Renewed regulatory or liquidity concerns just made that group an easy sell when risk appetite cooled.
Right, and when multiple pockets of the market face uncertainty simultaneously, banks, crypto, real estate, it compounds selling pressure.
Let's touch on some notable individual stocks. Alphabet kept drawing attention and held up relatively well despite the sell-off.
Alphabet continued to show the profile of a quality growth name. Ad monetization held up, and investors treated it as a buy-on-weakness candidate. Microsoft was similar. AI narrative and steady enterprise demand helped it resist the worst of the pullback.
Healthcare had some winners. Eli Lilly edged higher on pipeline optimism. That really shows how stock-specific stories can buck the broader trend.
Yes, when you have strong fundamentals or clear revenue drivers, those stocks can hold up even in risk-off environments. Broadcom and Marvell had mixed days in semiconductors. Broadcom, as an AI and hardware beneficiary, kept investor interest, while other chip names got hit with the tech weakness.
Motorola Solutions also held up better, given its defense and communications exposure. And retail was a mixed bag. Some names with cost advantages or AI-driven levers fared better than apparel names that are more cyclical. Okay, technical setup. The short-term damage was real. The S&P and Nasdaq broke intraday support levels that had been tested earlier in the week, and small caps sold through key levels. That's often an early warning sign.
For traders, that suggested a few tactical moves. Consider trimming levered or highly cyclical exposures. Think about rotating marginally into defensives like utilities and staples, or commodity beneficiaries, energy and selected materials. And look for oversold bounces in high-quality growth names as trading opportunities, with tight position sizing.
Short reaction. Watch the lows.
Right.
Short reaction. Don't over-leverage here.
Yeah, that tracks.
Looking ahead. What should listeners have on their radar tomorrow?
Focus on incoming macro data. Any inflation prints, payroll numbers, or manufacturing cues will be parsed for Fed implications. Also watch for Fed speakers. Their tone could push the market further one way or the other. And keep an eye on energy headlines, cannabis policy chatter, and company-specific earnings or guidance out of big tech and financials.
So the market was repricing higher near-term uncertainty rather than swinging decisively hawkish or dovish. If oil-driven inflation stuck around, that could push markets toward pricing in a longer run of higher rates. If growth or credit worries deepened, the Fed might face pressure to accommodate. So it's a tug of war.
Exactly. The next moves will be data-driven and headline-driven. For now, expect elevated volatility and thematic trading.
Quick tactical checklist for listeners. Reassess exposure to rate and credit-sensitive names. Identify high-quality franchises that can weather volatility. Consider defensive or commodity exposures on the margin, and keep position sizes sensible.
And for traders, watch for oversold bounces in quality names, but be disciplined with stop losses. Volatility can flip fast.
All right, time for our 3 clear takeaways before we sign off.
Number 1, the market closed the day with a clear risk-off tilt. Growthy and cyclical names were punished, and small caps led the decline. Number 2, energy strength and an oil spike reignited inflation worries, which mattered for policy expectations. Number 3, this is a data and headline-driven environment. Watch inflation prints, payrolls, Fed commentary, and sector headlines closely.
Great summary. Final point. If you want to dig deeper into any of these sectors or stocks, or send us a question, head to stockalpha.ai and use the Q&A feature. We'll answer live.
For more analysis and charts, visit stockalpha.ai and drop your questions in the Q&A so we can cover them next episode.
That's it for today. Thanks for listening to Alpha Recap. Stay disciplined out there, and we'll see you next time. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly, and we'll answer live. For more market analysis and insights, visit stockalpha.ai.